Hello everyone, Professor Kurzluck here. In this video we're going to talk about chapter 9 and 10, kind of the conclusion, the end of Elizabeth Berman's book, Thinking Like an Economist. Again, just focusing on chapters 9 and 10. So these chapters look at what Berman calls the economic style and how it became central to policymaking in the United States, particularly beginning with the Reagan administration, and how that legacy has shaped public policy debates up into the present. So let's set the stage. What is this economic style? So we talked about it in the beginning of the book, in the introduction in chapter 1. But to just set the stage, so since the 1960s, economists have steadily expanded. The profession of economics has expanded its field in government. Organizations, companies, think tanks, including like the Rand Corporation, the Rand Systems Analysis, first used in defense planning, was applied to other areas of government decision making. Agencies began to use cost-benefit analysis. Policymakers were trained in policy schools, which emphasized efficiency and cost-benefit analysis, and courts have increasingly drawn on economic reasoning. So we see economic thinking and rationale finding its way into the public policy making process. By the late 1970s, this economic style, with its emphasis on efficiency and incentives and trade-offs, was embraced across party lines. Both Democrats and Republicans used economic analysis, often for different ends, for different reasons, for different means. So Ronald Reagan, which is what Chapter 9 focused on. Ronald Reagan entered office in 1981 with a clear message. The government is not the solution. It is not the solution to our problem. Government is the problem. A pretty famous quote, even though I messed it up there. Government is not the solution to our problem. Government is the problem. His economic program rested on 4 key pillars: reducing the growth in government spending, cutting taxes, reducing regulation, and controlling inflation through tighter monetary policy. What is interesting about Reagan's approach is that he did not reject expertise entirely. So up to this point, again, we saw in earlier chapters where economic thinking was finding its way into the public policy making process. Our author Berman here argues that instead Reagan used economic approach kind of selectively. Expert and analysis were valuable when they supported his ideological goals, but were oftentimes dismissed when they did not. So Berman brings up and uses several examples to substantiate her claims. First, she looks at social policy. Whereas previous presidents had used economic analysis to improve the efficiency of welfare, housing, and labor programs, our author argues that Reagan instead sought to shrink these programs rather than to make them more efficient. Analytic offices like HHS, HUD, HUD were cut dramatically. For example, HSS's analytical staff fell from 165 individuals to 75. HUD's dropped from nearly 200 to about 140. Research funding was also scaled back. It declined. The Urban Institute lost millions in federal support, and Rand's domestic policy research shrank. At the same time, the policy conversation also shifted. Instead of asking, how do we end poverty efficiently, research began to ask, does welfare create dependency? This reframing, Berman argues, this reframing emphasized long-term welfare use, single motherhood, and so-called underclass. So this reframing shaped debates well beyond Reagan's presidency. By the 1990s, even Democratic policymakers had accepted the dependency, quote, dependency frame, influencing Bill Clinton's welfare reform. So Berman also talks about market governance and antitrust policy. Reagan fully embraced economics, specifically the Chicago School approach. The focus shifted from limiting corporate power or protecting small businesses to emphasizing efficiency and consumer welfare, mainly whether prices for consumers were low. The Department of Justice and the Federal Trade Commission reduced the number of lawyers and increased the number of economists. And antitrust enforcement fell sharply. Courts also adopted the consumer welfare standard, reinforcing this narrow focus. So this was a lasting change. The consumer welfare standard continues today to guide antitrust enforcement. Berman also highlights social regulation. Reagan also transformed regulation in general, though he expanded the use of economics in a specific way. His 1981 Executive Order 12291 required all major regulations to undergo cost-benefit analysis and created the Office of Information and Regulatory Affairs, OIRA, in the Office of Management and Budget to review them. Agencies like the EPA and OSHA hired more economists to conduct these analyses. But when analysis produced results that which conflicted with deregulation, Berman makes the argument that analysis, those recommendations were often ignored. Berman uses this example. She uses a famous example of leaded gasoline, where studies showed that stricter standards produced much greater economic benefits, though through better health outcomes. Despite efforts to roll back regulations, the stricter standards stayed in place. So in chapter 9, our author, she looks at how the Reagan Revolution brought about a change in thinking about economics in government. So, according to Berman, after Reagan, the two major parties diverged in how they used economic style. She argues that Republicans tended to use economic reasoning strategically. They embraced it when it supported their goals, like deregulation or market reforms, but set it aside when it conflicted with their priorities. For example, she argues, Republicans leaders sometimes dismissed Congressional Budget Office forecasts when the numbers did not support particular tax policies. Democrats, on the other hand, fully internalized the economic style as a neutral and responsible way of policymaking. They tended to see efficiency as the standard for serious policymaking. What that means is, for Democrats, Berman argues, alternative values such as equality, rights, or justice, which we saw in earlier chapters of the book, were were often sidelines because they did not fit neatly into the framework of efficiency. So Our author, Berman, looks at how Clinton and Obama used this thought process for their public policy making. So Clinton's 1993 Health Security Act illustrates this. Instead of proposing universal social insurance, his plans focused on managed competition using incentives, subsidies, and competition among insurers to control costs. In antitrust, Clinton's Justice Department reaffirmed the consumer welfare approach, with officials openly stating that their goal was not to challenge large corporations, but to follow mainstream economic reasoning. And in environmental regulation, Clinton revoked Reagan's executive order, but replaced it with one that still emphasized this cost-benefit analysis approach to public policy making, while adding attention to distributional impacts. So this idea of that Reagan's changes to government may have outlived Reagan's presidency. Berman also then looks at Barack Obama. Looks at Obama's Affordable Care Act, Obamacare, the ACA, which also relied on market mechanisms, exchanges, subsidies, mandates. The debate centered more on cost and coverage than on health care as a right or how to get as many people covered as possible. So during the 2008 financial crisis, responses like the stimulus check and bailouts were defended as necessary, technocratic measures. However, movements like Occupy Wall Street, with its slogan of the 99% versus the 1%, or we are the 99%, if you lived through this era, you would have heard these slogans, revealed how little language Democrats had outside of efficiency to frame issues of inequality, and how this idea of governing it wasn't always reinforced by what people in the party wanted. So by this point today, the economic style has become deeply embedded in U.S. policymaking. The Congressional Budget Office scores legislation in economic terms, shaping what bills were considered feasible. OIRA made cost-benefit analysis a central part of regulation. If you go to a public policy school, cost-benefit analysis, program evaluation are hallmarks of public policy programs. Courts have applied the consumer welfare standard to antitrust as well. And so together, these institutions ensured that policymakers had to, quote, speak economics if they wanted their proposals taken seriously. So Berman identifies lessons from history that she wants the readers to take away from. One is absolute principles can matter. Rights-based arguments, such as those used in the Disability Rights Act, succeeded where economic reasoning might have blocked progress. She also argues that efficiency is not neutral. Choosing efficiency as the main standard elevates certain values like low prices while downplaying others, such as fairness or political equality. She also points out that politics oftentimes blocks efficient solutions. For example, carbon taxes are widely seen as economically efficient, but have repeatedly failed politically. So Berman maybe takes kind of a critical view of the Democratic Party and the Republican Party in their use of efficiency instead of doing what is morally right. So her critique of the public policy making process comes out absolutely throughout the book. So she argues that some movements have tried to work within the economic style by translating values into economic terms. The ecosystem approach, the ecosystem services approach, assigned monetary value to natural systems like wetlands. The environmental justice movements pointed to unequal pollution burdens, which the APA reframed as risk burdens. These strategies sometimes gained attention, but also risked diluting the moral force of the original claims. So when we think of where we are today, so chapter 9 from Reagan and on, and then chapter 10, partly where we are today, and a wrap-up of the book. So in recent years, there have been signs of movement, Berman argues, signs of movement beyond the efficiency first framework. The Biden administration had emphasized equality, racial justice, and intergenerational concerns and regulatory review. So maybe a bit of a change away from other modern democratic administrations. So debates over climate policy and student loan forgiveness often highlight justice, fairness, and intergenerational responsibility in addition to efficiency. So Berman argues, though, that still efficiency remains deeply institutionalized. Policymakers continue to engage with it, but there is growing room for other values to enter the debate, she argues. So let's just wrap up. So chapter 9 looked at how Reagan used the economic style selectively. Embedding it deeply in public policy making, deeply in market governance, in regulation, while limiting its social policy. Democrats embraced the economic style pretty consistently, narrowing their range of arguments. Institutions like the CBO, OIRA, and courts entrenched efficiency as the dominant way of evaluating policy. And so today, efficiency remains central, but alternative frameworks centered on justice, rights, and equality are beginning to reemerge at the time of Berman's writing. So in class, we discussed and we debated, does that continue on to a post-Joe Biden presidency? And it is something interesting to think about and to debate. Okay, thank you very much.